Every time the markets panic, the same ritual follows. Central banks step in. Rates are cut, money is created, and a fragile calm returns. We're told this is stability. But there's a mystery here that never gets addressed. If central banks are stabilizing the system, why does each rescue seem to make the next crisis even worse? Why do recoveries feel weaker, debts get larger, and interventions become more extreme every single time? And why does a system, supposedly protected by the most powerful financial institutions in the world, now require constant life support? This is the great paradox at the heart of modern finance. Central banks don't actually eliminate instability. They just postpone it, while quietly amplifying the conditions for a much larger collapse. To understand how we got here, we need to trace the evolution of central banking. From its origins as an emergency firefighter, to its current role as the permanent architect of our entire economic system. Believe it or not, central banks were not created to control entire economies. Their original mandate was surprisingly narrow: act as a lender of last resort. Their job was to stabilize banking panics and protect the integrity of the payment system. The Bank of England, the Federal Reserve, the European Central Bank, they all emerged in response to specific crises, not as grand engines of economic growth. Their purpose was to smooth out short-term shocks, not to micromanage long-term outcomes. For many decades, this model seemed to work, at least on the surface. But underneath that apparent stability, something subtle began to change. Every intervention altered incentives. Every rescue rewrote expectations. And slowly, the system began to rely on central banks, not just as a backstop, but as its very foundation.
Back under the gold standard.
Central banks were constrained. They couldn't just create unlimited amounts of money without losing their gold reserves. Excessive intervention would trigger gold outflows, inflation, or even a currency collapse. These limits forced a certain kind of discipline. But the 20th century systematically dismantled those constraints. 2 world wars demanded massive financing, and being tied to gold became inconvenient. Eventually, that link was severed completely. Once money was no longer tied to a physical anchor, central banks gained unprecedented power. They could expand their balance sheets at will, suppress interest rates to near zero, and directly influence the price of financial assets. This newfound power was framed as flexibility. In reality, it removed the last natural brake on intervention. By the late 20th century, the entire philosophy of central banking had shifted. The new mission was clear: prevent recessions at almost any cost. Every economic downturn was treated as a failure of policy. Every market correction was seen as something to be softened or avoided. As a result, interest rates began a long, steady march downwards that lasted for decades. Debt levels, both public and private, quietly climbed to historic highs. And markets learned a very dangerous lesson: risk will always be backstopped. This is where the illusion of stability was born. Market volatility declined, not because the underlying risks had disappeared, but because they were being actively suppressed. The system looked calm and placid on the surface, but immense pressure was building up just underneath. Then, the global financial crisis of 2008 changed everything. The traditional tools failed. Interest rates hit zero, but it wasn't enough. The global banking system froze. Confidence evaporated overnight. In their desperation, central banks crossed a line they had long sworn they would never cross. They began creating money at an unimaginable scale, not to support bank lending, but to buy assets directly from the market. This program was called quantitative easing, or QE. QE was sold to the public as a temporary emergency measure. It never was. Once the markets adjusted to having central banks as permanent buyers, withdrawing that support became nearly impossible. Stability now required continuous intervention. The medicine had become the dependency. And here's the true cost of that printed stability. Asset prices, like stocks and real estate, rise much faster than wages and incomes. Debt becomes cheap and ubiquitous, encouraging risky behavior. Productive investment in the real economy gives way to financial engineering and speculation. Persistently low interest rates reward borrowers and relentlessly punish savers. They inflate enormous bubbles in asset markets without causing visible consumer price inflation, at least, until it suddenly appears everywhere at once. The economy becomes less resilient, not more. Small shocks, which would normally serve to correct excesses, no longer do so. Instead, they trigger panicked, oversized responses from policymakers. Central banks are forced to intervene earlier and more aggressively with each new scare. Stability itself becomes fragile. Every attempt to return to normal policy now runs into the same wall. They try to raise interest rates, the markets convulse, and governments struggle to service their massive debts. They try to shrink their balance sheets, liquidity dries up, and asset prices begin to wobble. But if they do nothing, inflation erodes public trust and eats away at purchasing power. There is no painless exit, because the entire system has been rebuilt around the expectation of permanent intervention. Central banks didn't just stabilize the markets, they fundamentally restructured them. Today, global debt exceeds 3 times the world's GDP. Central bank balance sheets have ballooned to sizes that would have been unimaginable just a generation ago. And financial markets now react more to subtle hints from central bankers than to actual economic data. So yes, stability exists, but only for as long as the intervention continues. Every pause raises fear. Every attempt at tightening policy triggers stress. This isn't control, it's containment. Central banks excel at one thing: managing short-term confidence. But they cannot create productivity. They cannot fix demographic challenges. They cannot resolve structural debt problems. All they can really do is buy time. With every delay, the cost of the eventual adjustment gets higher and higher. The system appears stable only because a collapse has been deferred, not because its root causes were ever fixed. Let's break this down into 3 key takeaways. First, central banks suppress short-term volatility, but amplify long-term systemic risk. Second, this printed stability creates a dangerous dependence, not genuine resilience. And third, every rescue mission dramatically raises the cost and complexity of the next one. The real danger isn't that central banks will suddenly lose control, it's that they never truly had it in the first place. They are managing the symptoms, not the disease. And the longer a collapse is postponed, the more violent it is likely to be when it finally arrives. The one unanswered question is simple: what happens when printing more money no longer restores confidence? If this analysis changed how you see central banks, money, or what market stability really means, then you're already starting to question the surface narrative. Subscribe for more deep dives into financial history, systemic risk, and the economic paradoxes that define our world. Because real stability doesn't come from printing confidence. It comes from understanding what's being delayed. Thanks for watching.